Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 27th, 2024. And in this week's episode, it's just myself, Sprocket888, and it's that time of the year again, quarterly earnings. And in this episode, I'm going to highlight two earnings plays that I am looking to put on probably tomorrow during the trading. They actually report earnings next week, but I thought I want to try to get maybe a week's worth of theta burn out of them. So I am likely going to put these trades on tomorrow, and we're going to take a look at Snap and Meta. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there and say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you're interested in hearing about. Also, you'll find a link to thetagang.com/sprocket888 where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find us, let us know and we will get it there. But let's hop to this week's content. And this week, I want to take a look at two earnings trades that I am going to be putting on this week, most likely tomorrow, as I said in the intro. And the reason I want to look at them is just kind of reiterate, what is it that I look for in an earnings trade and how did I arrive at these two underlyings to put on for earnings. And when it comes to earnings trades, one of the very, very most important things is elevated volatility. So volatility that is above where it normally trades at. And that's kind of one of the prerequisites that I put into my screener. So I look for extra extended volatility. That's usually in the terms, usually done by a measurement called IV percentile or IV rank or something like that. So it's usually a number between 1 and 100 or 0 and 100. And it's basically a percentile of how volatile is it in a range. What percentile of the range is it in? So if you are in the 86th percentile of this IV ranking, then that means you are at about the 86th percentile of the range of the high and the low of the highest volatility and lowest volatility of the underlying in the past year of trading. So 86% is very extended. I really consider anything extended above 65%. So I look for anything up in the 90s, the 80s, just really anything above that 65%. Now, the other piece that I'm going to be looking for is a historical trend of contraction at earnings. Now, that's almost everything will contract at earnings because that volatility is the unknown event of earnings. And as soon as earnings come out, that volatility will really evaporate. Now, there's a few things, meme stocks and things like that won't shed a lot of that volatility even after earnings. But generally speaking, you'll see a volatility contraction after earnings. And I'll show you in the chart where I kind of look for that contraction. And if I see a good historical trend of that contraction, it's likely to mean it will occur again. And then last, I'm really kind of looking for an underlying size. And, the bigger the underlying size, the more premium is involved, but also the more risk is involved. And so you'll see a pretty wide array. So Snap, which I'm going to look at, is a very, very small underlying. And so it's a really small amount of premium, but percentage-wise, based on the stock price and the amount of premium you can collect, the percentage of that, it's very high. Where Meta is an extremely high cost for the underlying, so there will be a good chunk of premium in it simply because it represents a large notional value. But the percentage that the premium is relative to the stock price will be less than Snap. And you kind of have to take that into consideration when you're kind of looking for premium and looking for spot volatility. And so I'll show you on the screener a couple of the interesting things which drew me to both Snap and Meta. All right, so first up is Snap. And the reason Snap hit my charts is because I looked at things that had earnings within the next week, and Snap's earnings are mid next week. And that basically had extended volatility. So I was looking for volatility percentiles. I sorted them by that. So I was looking at the high ones and then kind of going down for a high spot volatility in conjunction with a high IV percentile. And Snap was one of the first ones that jumped out to me. So Snap was sitting at about an 86 percentile of IV rank, which basically means it's very extended. That means 24% of the time it had a higher volatility, but 86% of the time it had a lower volatility. Sorry, 16% of the time it had a higher volatility. And then 86% of the time it was lower than it was today. It also had a spot volatility of about 100%. Which is very, very good. So let's take a look here at the option chain for Snap. And what I want to show you here is that week of earnings. So these yellows are weekly expirations, and November 1st is next Friday's expiration, or this week's expiration, I should say. And look at the volatility levels of this. So for options that are expiring the week before earnings, we're looking at 74% volatility. The week of earnings is 172% volatility. The week after earnings drops down to 139% volatility. And then you can see it gets less and less volatile from there. So really what I want to look at is the week of earnings. And that is this option chain that expires on November 1st. And so what I'm going to do is I'm going to come down here and I'm going to look for, I typically try to start at about a 20 delta. And so here I have a choices of around a 25 delta or an 18 delta. Now, because this is such a low underlying, I was kind of comfortable coming up from that 20 delta to put my lower strike at a 25 delta, collecting likely around 44 cents of premium. Now, I'm going to go ahead and make this a strangle. So I'm going to play basically delta neutral. So I'm playing that Snap is going to stay in a range. Now, Snap is a little interesting, and you'll see in the chart here in a minute what I mean by that. But I'm going to go ahead and come down and look for another 20 delta. So down here, I've got a choice of a 22 delta or an 18 delta at the 1350 strike, or go with 22 at 13. So I'm going to go ahead and take the 13 strike, which is actually a 22 delta. So this is a little aggressive than I normally do for strangles, but the volatility is very extended and the underlying prices are relatively low. And this is basically going to collect me 75 cents in premium, putting up buying power of about $200 per contract. Now, I want to size this up a little bit more. So I'm going to probably jump up here to a contract size of 20 of these contracts that I'll trade at around 75 cents. So one of the things I want to bring up, I alluded to kind of the chart and why it might be a little bit interesting. And here is what I mean by interesting. So what you see here is the daily candles of Snap over the past year. And the one thing I want to call out, this chart below that goes red, green, red, green, red, green, this is the volatility chart. And what I want you to call out is just above this chart, you'll see these blue dots. This is an earnings announcement. This is an earnings announcement. This is an earnings announcement. And look at this cliff. This is the type of cliff that I want to see. That basically is telling me there is some massive, massive volatility contraction after every earnings. Now, there's a gotcha here. And the gotcha here is, look at this. It almost looks like a step function. So here Snap is cruising along and then earnings come out and whomp. Down here it's trading along and earnings come out and whomp. It's up here now, earnings come out and whomp. So this is a negative in my mind for this particular trade. Why is this a negative? Well, it's a negative because this move likely was beyond the expected volatility or movement that was coming out of Snap. So, if history repeats itself, we might be gapping up with a major gap and kind of coming up to this previous trading range, which was, around the 14 to 1450 to maybe up to 1750 trading range. That is well in the money of my strikes. So here we have a very high probability of breaching my strike. And if you notice, the last time that we kind of went into earnings, we were maybe trading around $10 or $11, and we didn't come back to that $10 or $11 for a whole quarter. So this will be interesting to see how it plays out. This is the one negative drawback, but like I said, this really has that key characteristic down here of this massive volatility contraction in earnings. And we are certainly pumped up. You can see only in one of the previous earnings over the past year did we actually have volatility that was this high. So that is exactly why I'm kind of looking at this trade to enter it. Now, one of the other things I like to pull up is what I call the Flappy Bird chart. So let's go ahead and switch over here a little bit to the Flappy Bird chart. And you can see I put these red boxes. These red boxes are where those strikes would be. The strikes that I picked were a $9 strike to the bottom side and a $13 strike to the upside. That is about the 20 delta. If you'll notice, this isn't exactly in the middle. And that's because Snap has a little bit of call skew, which means the premium on the call side is actually higher than the premium on the put side. This means that the market basically sees risk to the upside, and that creates the ability for the premium seller to stretch for the same amount of premium farther out on strikes. So that's why this doesn't look exactly in the middle, but that delta is the normalizer. That 20 delta that I targeted is really going to kind of support that, the range is the probability. So a 16 delta is about a 1 standard deviation move. I'm kind of saying, hey, we're going to stay below 1 standard deviation. Now, like I said, the historical trend of this really shows Snap popping high and going there. So there is a very, very high probability that we might breach the strike. Although I am kind of saying, you know what, I'm okay being short these shares if we breach to the high side or long the shares if we breach to the low side, because a lot of times we're going to get a snapback har on the next quarterly earnings of that, at least as far as the trend goes historic. All right, so the next ticker that kind of jumped out to me on my screener was Meta. So Meta, formerly known as Facebook, on the exchange, it didn't quite have as high of a spot volatility. So the spot volatility was only about 47%, but it was in the 82 percentile of IV rank, which means 82% of the time volatility was less than where it is right now. And they were also coming into earnings. And so this one really kind of jumped out as a potential play here, as well as earnings. So their earnings are also coming up. And we're going to go ahead and take a look at the option chain here for Meta. And when we look at the option chain here for Meta, you can see, the week, the Friday, the 25th of October, 30% volatility. The week of earnings, we jump up to 71% volatility. Then the week after earnings, we fall off to 60%. And so on and so forth, you can see extending away. So we want to capture that overextended volatility. So 70% week ending in November 1st is really where we want to target. And again, we'll scroll through here looking for about a 20 delta. And then as we come up here, we got an 18 delta and we got a 21 delta. So again, we're overextended. I'm going to probably pull this on the more aggressive side, and I'm going to take this 525 put strike, selling for between 730 and 750 a contract. And then I'm going to go ahead and scroll down on the call side. And if I look down at the call side, again, I'm going to look for probably that 16 to 25 delta. We'll try to hit close to a 20 delta. Now, this one's interesting. I could get a little bit more aggressive and go after the 620, which would match me a 21 delta on both, or I could back off a little bit and take the 625 strike. So, all this will change when the market is actually open and I'm kind of looking at it. But as it goes here, if I go ahead and we'll get a little aggressive and call it the 620. This is going to pick up about $14 for me in premium. And then this buying power is pretty substantial here. I'm not sure that I'll end up taking this just on the buying power. You can reduce some of this by buying protection legs. If I come out here and purchase something, but that'll take away from what I'm pulling in. But I want to show you what the chart of Facebook kind of looks like, because I want to call out that it has a very similar trend to the Snap chart that we had looked at as far as we got our extended volatility, what happens on those earnings. So here is the Meta chart, and up here in the top, we have all of our different, you got your earnings here, we got your earnings here. They're the blue dots up here. And what you see below is not quite as pronounced as Snap, but you get a volatility contraction here. You get a very big volatility contraction here. You get a brief volatility contraction here at these earnings. But look, you don't get quite as much of that step function curve. So we don't quite get the swings. And Meta, I feel a little bit more comfortable on the strangle because it's a much, much larger underlying and it has high volume and it's not really as prone to those really, really massive, like Snap could be up 50% after earnings or it could be down 30%. It's possible, always possible to move like that. But the size of Meta and the amount of things that buy into Meta, it's less likely to experience those, double-digit percentile swings. Could it happen? Absolutely can happen. Has it happened historically? Yes, it has. But this is really going to kind of pull in really a good bit of premium here on Meta. The other thing I want to call out on Meta is basically that Flappy Bird chart. So if we kind of come over to the Flappy Bird chart, I've gone ahead and I've put assuming that I enter this thing at the upcoming trading day, that's where the red box starts. The top side of this is at that 625 strike or 620 strike. And that bottom side of the box is that 525 strike. Now you can see this does look like it's a lot more in the middle, and that's because the Meta doesn't really have that call skew. So the 20 delta to the top side, 20 delta to the bottom side, you're going to be about equidistant from where it's currently trading. A lot of options will typically have put skew, which means the put side will have more of the premium than the call side. And that's usually because they're used to purchase protection for shareholders. When you get call skew, you get a lot more speculation. So you'll see a lot of meme stocks will have very, very high call skew, meaning that there's a lot more of that stuff traded to the upside versus more of the contracts traded to the downside. And that's what generates that skew that you see. Meta's pretty balanced here on this particular expiration going into earnings. And you can see this is the daily candles over the past, these are the 4-hour candles over the past maybe 2 months worth of trading. You can see we're only looking for a couple of days of movement. So we'll really see how the earnings come out for Meta. And we're going to hope for a hey did a little right down the middle. Now, one last view that I want to show you is more of my table chart to really show you what the return on capital could be. Now, this will vary because I have not entered these trades and I don't know where the market is going to open and I don't know where the delta and volatility are going to be. But it will be roughly in the vicinity that you saw for roughly the premiums that I showed on this particular recording. But if we go ahead and we take a look here by the chart of Snap. Now, Snap is that short put and short call. It's known as a short strangle. And that's at the $9 put, $13 call, week of expiration of earnings. So November 1st, 75 cents a contract, 20 contracts. That will be collecting about $1,500. And that was going to require about $4,100 of buying power on my account. So you do the math, 1,500 divided by 4,100, and that comes up with roughly 36% return on capital. Now, I will likely not hold that into expiration. I will likely close it the day after earnings. But if I remember correctly, Snap earnings was maybe about halfway through towards the back half of this 1-week trade. So it will be a few days, but I will close it out, and that's a pretty decent return on capital. So my return on capital will close out once I recover about 50% or more of my premium. So really, I would be looking at more along the lines of a 18% return on capital because I would leave some on the table, not riding it into expiration. Although, if it hits right in the middle, I could easily see an 80% to 87% reduction in premium, which would yield a return on capital much closer to this 36%. So I'll keep you posted. We'll see how it goes. The other one, Meta, you can see requires a good bit more of buying power. That's largely because of where the strikes are. So 525 and 620. Now this, due to size, will only trade one of these contracts. I know in the previous clip, it basically showed a $11,000 buying power. This really depends. I have a couple different brokers. The one broker that I will enter this trade in was going to require about $6,200 of capital to be put up in margin. And so this is going to yield about $1,400 in premium. Divide that out by the 6.2K in buying power this trade is going to consume, and that will be about a 23% return on capital, simply dividing the 1,400 by 6,200 to get that return on capital. That brings us to the end of this week's episode. I just wanted to highlight this is where I'm deploying capital. So just taking you guys for a ride along with me on, what's going through my head. What am I putting trades on? Once we get through earnings season, I might start looking for a little bit longer term trade. These earning trades are very nice because they can pop almost 100% of your profit overnight, which is awesome. Occasionally you get challenged. Occasionally you'll get breached. There typically almost always is the ability to roll. And then you kind of get into extending the trade a little bit, rolling it, collecting some more premium. Both of these underlyings, both Snap and Meta, looks like they have a good high probability or chance to generate rolls. If not, in both cases, I am comfortable with assignment, whether or not it's on the you own the shares or you're short the shares, depending on whether or not it's breached to the low side or the high side. Remember, these option contracts, I am obligated to honor the contract that I sold. So if we go past my strike to the high side, I am obligated to buy those shares and provide 100 shares of Facebook to whoever it is that holds that contract. And if it were to breach the low side, I am obligated to buy the shares at that strike price from whoever it is that owned that contract, should they decide to exercise it. We'll see how these things pan out. I'll let you know. We'll keep you posted. You can check out thetagang.com/Sprocket888. That is where the results will be posted before they ever get mentioned on a video. So good luck out there to all of you. Very volatile times out there in the market. There's something called an election or something coming up here in about a week or so. We'll see what happens after that. The market will relieve a little bit of volatility kind of going into that, most likely. It's not so much of a binary event around like an earnings, but there definitely is volatility in the market that is related to that. But I think it's far drowned out by all of the other factors that are introducing volatility. So hopefully you're trading something that you can find something that you're interested in traded, and you have the best of luck out there. And remember, think outside the block.